Morning. Okay. Is it on? Jet. Coming. All right, today we're dealing with impairment. Impairment is covered by IAS 36. And we've touched on this word impairment when we were talking about PPE, because we said assets carried at cost are carried at cost less depreciation, less impairment. And at the time I said to you that impairment we would look at when we looked at it's a separate section, a separate standard, and that we would look at it later. But impairment is defined very simply as when the carrying amount of the asset exceeds the recoverable amount. It comes from asset definition. If you remember asset definition says that an asset is a resource controlled by the entity from which future economic benefits will flow. When these future benefits that will flow are less than the carrying amount, then we have a piece of asset that doesn't meet asset definition. Do you agree? So if I have a recoverable amount of 100, but the future benefits from the asset are only 80, then there's an amount of 20 which doesn't meet asset definition and therefore needs to be written off. So when the carrying amount is bigger than the recoverable amount, we have impairment. Recoverable amount is the higher of, and there are two ways that we can get future benefits from an asset. We can either sell it, selling price less costs to sell. Yeah, recoverable amount is the higher of, they actually say fair value less costs to sell, but essentially the same thing. Fair value less costs to sell, or value in use. So when I have an item of PPE, I have two options with that item. I either keep it and use it and generate cash, or I sell it and generate cash. Yeah. So when I'm looking at recoverable amount, I look at the higher of the fair value less costs or the value in use. So clearly, you can already see three calculations when we're doing an impairment test, or when we have to work out impairment. You have to work out a carrying amount, you have to work out a fair value less costs to sell, and you have to work out a value in use. And then you have to determine whether or not you have impairment. And impairment would be if my carrying amount is bigger than my recoverable amount. Let's talk about recognition. When do I recognize an impairment? The statement says that we only test for impairment when there are indicators. We would not test all assets for impairment at every year end. Only if there are indicators of impairment. And they talk about external indicators and internal indicators. External indicators are in the market. It could be that the value of an asset has declined in the market. Maybe it's damaged. It could be that there's a new competitor and so therefore your asset is now worth less because you have to reduce your prices. It could be a change in technology and suddenly your machine is not so high-tech anymore. Or it could be internal. Internal indicators of impairment could be obsolescence, could be a choice to discontinue a certain product line and now you're not using the asset anymore. Any of those things. We look for indicators of impairment. So at year end, all management has to do is ask themselves, is there an indicator of impairment for any of my assets? And that's all. So they don't have to go and do the whole test for all their assets. They just have to consider, are there any indicators that some of my assets are impaired? So I don't know. For example, I remember a client of mine saying to me that there was a machine which was being underutilized. It was basically sort of mothballed. And he said that made him think that maybe he needed to record some kind of impairment, which was correct, isn't it? Or at least he needed to have tested for impairment at that stage. Initial measurement is fairly straightforward. Initial measurement is very simply the amount by which carrying amount exceeds recoverable amount. That's my impairment. And this impairment goes to P&L. It's sometimes referred to as accelerated depreciation. I'm just depreciating the asset a bit quicker because the asset is not worth what I'm carrying it at, so I have to reduce that value. And this line, impairment, shows in your PPE note as one of the movements. Like you have depreciation, you will now have a line that says impairment. And impairment is very simply calculated as that. Okay, so we're going to have a look at a practice of a question. Before we get there, let me just talk about these calculations. So carrying amount is something we've been doing all along. Do you agree? Since our first lecture when we did PPE. Fair value less costs to sell is usually given. They have to say to you, this is the fair value, and then sometimes they give you costs, or you have to do a little bit of a calculation to work out costs, and you can get a number. Value in use. Value in use is a present value calc. It's the present value of the future cash flows on this asset over the remaining life. So depending how they give you the cash flows, it could be one fixed amount per annum, yeah? And if it's one fixed amount per annum, you just put it into your calculator as payment, and they'll give you a discount rate to use. In practice, that discount rate can be a little bit challenging to determine, but for you, they will give you the discount rate. Or it could be different amounts each year, in which case then you use the cash flow function on your calculator. But basically, your steps are, they give you a story and tell you about an indicator. That indicator tells you have to calculate impairment. You calculate the carrying amount of the asset. That's normal calcs that you've been doing up to now. We then determine recoverable amount by looking at the higher of fair value or value in use. Value in use is a PV calc. If then, when we compare carrying amount to recoverable amount, the carrying amount is bigger, we have an impairment. All right, so in your study guides, there's an example 1, which is a simple example, but for you to Blanche Limited, page 141. Blanche Limited is a company that produces and sells wine. The company has a March year end. On the 1st of April, they purchased Blanche Veritas, a brand name, for 4.25 million rand. It had a life of 8 years and no residual. The name was ready to be used at acquisition date 1 April 2009. Due to an employee strike action, the Gauteng bottling plant had to use temporary staff. The temporary workers were not sufficiently trained in the use of the machine, and as a result, 20,000 bottles that were filled in the months of July and August became spoiled as they had not been properly sealed. Management only became aware of the problem after the brand received negative publicity and subsequently recalled all those bottles of wine. The effect of the negative publicity on the brand name was assessed on March 2011. The fair value less costs to sell on that date were 2.2 million. Due to the negative publicity, possible impairment had to be assessed. Management expects the brand to generate the following cash flows over its remaining life. Remaining life is 5 years. So we bought it in 2009. Our first year end was 10. 10, 11. That doesn't sound right. 10, 11, 12. It looks like they've reduced the life, isn't it? Because we're not balancing back to 8 years, are we? Or maybe I'm wrong. No, 5 plus 2 is 7. Anyway. This is the remaining cash flows over the rest of its life, and they're going 1 year, yeah? Yeah. So there they are. And a pre-tax discount rate is 15%. Whenever students see this, you have this urge to adjust it, isn't it, to after tax, or I don't know, do something with it. The rule is always like with like. If my cash flows are pre-tax, then I use a pre-tax discount rate. If my cash flows are after tax, I use an after-tax discount rate, isn't it? Usually when we're looking at returns on assets, we're looking pre-tax, isn't it, if you think about when we do the ratios. So we assume, unless we were told otherwise, that these cash flows are pre-tax cash flows, they're the returns from the asset before I have to pay tax, because lots of other things come into a tax calc, isn't it? And therefore, I will use the pre-tax discount rate of 15. I won't adjust it. All right. So, 3 numbers you need to calculate. You need to calculate a carrying amount. Carrying amount you're going to do from here. It should be fairly straightforward. The brand was bought 1 April 2009. It has no residual and a life of 8 years. We are now at 31 March 11. Okay? Then you have to work out recoverable amount. Recoverable amount is the higher of fair value less costs to sell. There it is. Let me do it in a different color. Here it is. Fair value less costs to sell. That's the second of the numbers we need to work out. And then you have to work out a third number. The third number is this number here. It's value in use. You're going to work out the present value of those cash flows. On your financial calculator, you will use the CFI function to do this, or CFJ, whatever it's called on your calculator. And remember that year naught is nil. You have to put year naught first. Your calculator assumes the first number you give it is year naught. Year naught is today, it's nil. Your first cash flow there is year 1. So you will put those cash flows in, year 1, 2, 3, 4, 5. Discount rates of 15, and you will work out an NPV, and that will be the value in use. Then recoverable amount will be the higher of fair value or value in use, and you will compare that with carrying amount and then determine if we have impairment or not. So I'm going to let you do that. Okay, carrying amount 425. You didn't get it? Oh, NPV, 15I, compute NPV. You don't have your financial here. You know how to do it? On your calculator? Okay, so carrying amount was easy to work out. It was an 8-year life. There were 6 years remaining. 2 years had passed from April 9 to March 11. 9, 10, 11. So that's your carrying amount, 3187.5. That's the value of your asset. Then we have to work out recoverable amount. Why? Because there was an indicator. The indicator was the negative publicity and the fact that they had to recall the wine, right? So recoverable amount is the higher of fair value less costs or value in use. Value in use, remember, is the present value of the future cash flows. Sometimes it's a simpler calc. Sometimes it's more, but uglier like this one. But sometimes you even have to work out the cash flows. I've seen that, but I think more like at an honors level. The higher of fair value or value in use is value in use, isn't it? Because value in use is 2.8 million. Fair value is 2.2 million. So I will disregard the 2.2 million, and then I will work out my impairment. My impairment is the difference between the two, and the impairment, the amount that I will write the asset down by, is 3187.5 less the 2860.1. It's 327,400 is my impairment. Yeah? And so when I'm working on this asset, I will have an amount at beginning of year. I will have a depreciation amount for this year. I will have an impairment, and I will land at the end of the year on 2860.1. I'm going to show you disclosure a little bit later. This is just calcs, right? Yeah, this is just calcs. I'll show you disclosure a little bit later. But what I want you to do, what I want to talk to you now about is about subsequent measurement. Subsequent measurement. So, so far we've dealt with, let me just put it like this. So far we've dealt with 3 steps of accounting treatment for impairment. We've dealt with definition, recognition, and initial measurement, and now we're going to deal with subsequent measurement. Subsequent measurement is measurements in subsequent year ends. And the thing with subsequent measurement and impairment has to do with impairment reversals. Impairment reversals. Impairment reversals are allowed. You are allowed to do an impairment reversal. It's just the amount of the reversal that you need to be very careful with. And the rule for an impairment reversal is that the amount of the reversal, the maximum reversal, cannot be bigger than what the carrying amount would have been without impairment. That's the maximum reversal that you're allowed to do. What the carrying amount would have been without impairment. So if I use the information in this previous question, then I'm going to let you practice one. If I use the information in the previous question, I had a carrying amount which was 4250. I had depreciation of, what was the amount? 1062.5. And then I was left with 3187.5. And do you agree that at that stage, I'm just going to ignore it backwards, the remaining life was 5 years? When I worked out the impairment, my remaining life was 5 years. Do you agree? Because that was what it said the cash flows were for the next 5 years. Then I impaired it. And when I impaired it, my impaired value over here was 2860.1. And you agree it also had 5 years left of life, yeah? So let's assume 1 more year passes. And if I depreciated 2860.1 over 1 more year, because this is now my number, do you agree? This is now my number that I will carry. I would pass an entry for depreciation of 572.02. And at end of year, my carrying amount would be 2288.08. Okay? So, I had that carrying amount. I impaired it. This is what it looks like in my books at the moment, isn't it? It's impaired. That was my value then. 1 year later, that's my value. Now, if I said to you that at the second year end, we've done a lot of work in the market, and we've determined that we've been able to correct our brand name, yeah, to fix it. People now are happy to drink our wine again, and our brand name is fixed. And if I say to you that at that stage then, my recoverable amount has gone back up to 3 million. So initially your thought would be, let me reverse impairment. If I had to reverse impairment, the reversal of impairment would be about 700 odd. $711.92. So I say to myself, okay, maybe I should reverse impairment, take it up to the 3 million. I'm reversing 711.92. If I look back at what I had impaired, come on, behave. My impairment had been, it only had been 300,000. Okay, I've gone too far. All right, sorry, no, I can't go that far because otherwise, obviously, that's it. We would never be able to reverse that much. But that's not what I want to show you. But I also want it to work. Sorry, I make up numbers and then they don't work. Let me just check quickly. What was the impairment before? $327. Okay. Sorry, let me just correct these numbers just to make it work. Number doesn't work like that. All right, so let's assume that the recoverable amount at this stage is 26. And that then I would want to reverse impairment by 311.92. Okay. So what I would then need to check is my rule. I would need to check what the carrying amount would have been if I had never impaired. So I go back to the costs column, carrying amount, no impairment, and I calculate what that would have been. Because that's the maximum that I can reverse impairment by. So I go back to what it would have been. If I go back to what it would have been without impairment, it would have been 2550. 3187.5 divided by 5 is depreciation of 637.5, and my carrying amount would have been 2550. So what the rule says is that you're allowed to reverse impairment. Well, first of all, we wouldn't be able to reverse more than what we had impaired, isn't it? Because that's fairly obvious. However, this rule overrides that. Because what this rule says is that the maximum reversal can't be more than what the carrying amount would have been, cannot get you to more than that number. Because if we hadn't impaired at all, we would have put depreciation into our books this year of 637.5, and we would have landed on 2550. Now, we want to reverse impairment. The maximum that we can reverse impairment to will be 2550. And the maximum, therefore, that we can reverse is 50 less 261.92. Yeah? So that's the rule for impairment reversals. The rule is that the maximum reversal cannot be more than what the carrying amount would have been. The minute we see a reversal, we have to have the two columns. We have to have the column of the value of the impaired asset, and we have to have the column of the value of what the asset would have been had it never been impaired. Because when we're looking at reversing, we then will do a maximum. If I had said to you that the reversal is back to, say, 2.4, then 2.4 is less than the 2550, then I could go to 2.4, isn't it? But if I want to go above 2.4, above 2550, then it won't let me, and the maximum that I can go to is 2550. Okay, because do you agree that if I start reversing by more, I'm creating profit? Yeah. If I had never done anything, that would have been my balance, and the difference between that and that would have been the depreciation over the years. What this is trying to prevent is companies putting impairments through in one year and reversing them in the other by more, and then landing up moving profits or even creating profits. Yeah. All right. So in your study guides, there's an example. It's example 2. I just want you to follow example 2 and do the calcs, because then we're actually going to do example 3. So I want you to read example 2 with example 3. Example 3 says the same information as example 1 applies, but it isn't. It's example 2. And then they say, during the year, the competitor ran into financial difficulties and liquidated. This resulted in a positive effect on cash flows, and now we have a possible reversal of impairment losses. Yeah, but you need to work out for me what that reversal is. So, example 2 which is on page, is a big story, but it's not a lot of work, which is on page 143, is the impairment. The impairment happens in March 12, and then I think a year or two later, in example 3, is the reversal of impairment, and I want you to just follow it through all the way. Okay, so this impairment is an easier one. It just says, Toys for You is a company listed on the JSE. The primary segment is the manufacturing and selling of toys and clothing. They obtained the license to sell bogus toys for 25 years, and the license was 2.5 million rand, and it will be amortized straight line. So here's my license, 2.5, 25 years. I can work out carrying amount as at end of year. Do you agree? On the 31st of March 12, it's estimated the license will generate cash flows of 750 per annum. So what you have to do, that's value in use. You have to work out the remaining life at that stage, and then you can just use the payment function on your calculator to do the PV. Yeah, it's not different amounts every year, it's the same amount every year. The annual cash flow to generate these cash inflows is that. So it's actually going to be the one minus the other. Cash in minus cash out will be your net cash flow. Assume that all annual cash flows occur annually at 31 March and a pre-tax discount rate is 20%. So it's going to be easy to do value in use. All you have to do is work out remaining life for your N. Your payment will be 750 less 325. Your I will be 20, and you can work out your value in use, which is your present value. However, the future cash flow is now less than the original estimate. Oh, okay. That was estimated at that time. Because a second license was awarded to a major competitor. The estimated useful life remains unchanged. No, those are the value in uses. I don't know. The license can be sold for 2 million rand. So this is fair value. For the year ended 31 March 11, recoverable amount exceeded carrying amount. So last year we were okay, we weren't impaired. Deferred tax, okay, don't worry about deferred tax. I'll talk to you about tax, but there's nothing major about tax with impairment. Okay. Oh gosh, what happened here? Things went all unaligned. All right, so I want you to do a quick calc for me. As at March 12 of impairment. It should be quicker to do than the last one because there's no funny cash flows. It's just one amount, an annuity. So I want to see 3 numbers. A number for carrying amount, a number for value in use, and a number for fair value less costs to sell. And I want to see an impairment. Why does it do that? And the resulting impairment then. Okay, that's just to start you off. Only because to do the reversal question, we have to be able to do this one first. Should be fairly quick to do. Carrying amount, value in use, fair value, impairment. Okay. Should have been easy enough to calculate. Carrying amount, 23. Value in use, 2092.923. Fair value was given 2 million. So this will be my recoverable amount. This one here. How weird is that? What kind of funny things is it doing now? This is going to be, and now, oh, there, now it's working. That's going to be my recoverable amount, and so my impairment is 207,077. All agree with those numbers? All right, so as at March 12, my impairment is 207077. My new carrying amount is my impaired amount, 2092923. And my remaining life at that stage is 23 years. Do you agree? 23 years. Okay. We fast forward. I'll come back and show you disclosure. We fast forward to example 3. And in example 3, it says the following information as for example 2 applies. And they've given you the carrying amounts as at December 13, March 13 and March 14. But you can work forward to those numbers, isn't it? I'd like you to do that because they may not give it to you. So assume they haven't given you these 2 numbers and you work them out. And then they say to you, during 2013, the competitor ran into financial difficulties and was liquidated. It had a positive effect on cash flows and resulted in the value in use being 2.2 million. So here are your value in uses and your selling prices over here. And the first indicator of the reversal of impairment is now in 2014 here, that we start to see the numbers going up. So as at March 2014, there's a possible reversal of impairment. I want you to work out for me what that reversal is. Okay, remember, in order to do the reversal, you have to work out what the amount will be once you have to work out what the carrying amount would have been if you had never done the reversal, isn't it? So you can work it out. So you need to have the 2 columns. You need to have carrying amount, no impairment, and you need to have carrying amount, impairment, 2 columns. And you need to trace those numbers through to the end of the year. Okay, so you can start both of those with beginning of year. But you probably need to go back, isn't it? I don't know. Basically, I need beginning of year to end of year for those. And I need you to work out what the reversal would be. It looks like, well, this bit's fairly obvious. The higher of value in use or selling price is clearly that one, isn't it? So that's what we would want to reverse to. So whatever my number is in this column at end of year, I want to reverse to get back to 2.2. That's the maximum amount that I would want to reverse. But now the rule says I can only reverse back to what the carrying amount would have been. So I want you to calculate for me what the carrying amount would have been with no reversal. And I know they gave it to you, but I want you to check it anyway. And I want you to practice doing the calcs. Do a calculation, carrying amount, no impairment. Do it from beginning all the way to end. So over here, do it from beginning all the way to end. This column here, let me see if there's space at the bottom. Empty space. No, there is a bit. Okay, so for this column over here, I want you to start with cost and get ACDEP to beginning of year. And then depreciation to end of year. That's what I want you to get to for that column. That's your normal calc that you always would have done. For the impairment column, you're going to have the impaired amount, and then you're going to have ACDEP to beginning of year, depreciation to end of year, and then you're going to check your numbers so that you can work out your reversal. Usually your reversal is from here back to there, maximum reversal. But you need to check that it's not bigger than what you want to reverse to, which is the 2.2 obviously. Okay, so you're going to do your 2 columns, your carrying amount no impairment column and your carrying amount with impairment column. And you're going to get to the values at your end for both of those, and the difference between the 2 is the maximum amount of reversal. We start with the impairment 2092 something, 0.1, 0.08. And that was when there were 23 years left, isn't it? 23? Yeah. Okay, so 2092.08. So 1 year of depreciation is 90.96, leaving us on 200112 at beginning of year. If I take off another 90.96, it leaves us on 1910.16 at year end. Okay, and those numbers were the same numbers that were given to you here. Yeah? It's rounding. Yeah, I'm not going to bother about the rounding. Okay, so 19. Sorry, that looks ugly. Can't even read what it says. 1901.16. And I know it's not the number they have because of rounding. I don't know, I've rounded somewhere. Funny. Okay. Now, we reached that number, 1901, at year end. The new recoverable amount, which I had highlighted there, is 2.2 million. And so the question then arises, should I go back to 2.2 million, or what can I go back to? And the answer is, you can only go back to 2.1. Yeah. So your maximum reversal is between 1901 and 2.1. Sorry, I am working in thousands. I don't even want to go see where my error is. So the maximum amount that can be reversed is 199. And what will happen at your end is I will reverse 199 to get me back to 2100. Where? The previous question we got to 2092. 2092. Oh, 08, I thought it was. Oh, sorry, I heard somebody say 08. Okay, that's why. Okay, well, then that's what it is. It's 2092, whatever we had as the impaired amount. Sorry, I heard 08. So I wrote down 08 and moved on with that. Okay. I didn't want to write it on the board earlier because then I see you guys just watching me and copying what I'm writing. I wanted to make sure that you got a chance to do it. So I wrote that number down wrong, but in thousands. 2.5 million here, 2092 over there. That one goes from 23 years down. This one was at 25 years. I worked from there down. I'll end up at end of year with 1901 and 2100. I reverse depreciation. I reverse impairment of 199. I cannot reverse back to 22 because then I'm creating an asset, isn't it? That otherwise wouldn't have been there if I had never impaired. All right, let me show you the disclosures. I wanted to show you the disclosures. This was the original impairment. Yeah, the question 2, when we did the original impairment in 2012. Don't worry about accounting policies. Don't ask accounting policy notes. Accounting policy notes is just really your accounting principles, isn't it? It's just saying how you account for things. We start always with a profit before tax note. Included in the profit before tax is amortization of 100 and an impairment of 207,777. So just like we put depreciation, in this case it's amort because it's an intangible, we also put impairment into the profit before tax note. Okay. Then there's an income tax note and a deferred tax note. I'll talk to you about deferred tax. I'll show you the deferred tax calc. And now, is that it? They don't show anything else. These are all calcs, eh? All right, maybe in this one they show the others. Okay, here they show the asset side, the asset note. So what you can see in the asset note is any impairment or reversal of impairment gets shown as your movement, yeah, just like depreciation or amortization would be shown in your movements. And then what you also see, so this is the two key things, in your movement, in your asset note, this one is intangibles, but it could be PPE, will be any reversal or any impairment would show in your movement. In addition to that then, this impairment is shown in accumulated depreciation and impairment. So the wording changes when we have an impairment. It used to be just accumulated depreciation. Now it's accumulated depreciation and impairment. Yeah. What you see after we've reversed impairment, then there is no more impairment. So then it just goes back to saying accumulated amortization. Then there's also a note, an impairment note. You're required to do this impairment note. It's just a story. It's just a story, the impairment note, blah, blah, blah. It's just descriptive, and it just talks about what the impairment is, what causes the impairment, how much the amount is. It's just a story. Yeah. So in the previous one, they didn't show that note, but here you can see whether it's a reversal or whether it's just a normal impairment. If it's material, we show this note. Okay, impairment note, if material. They'd have to tell you in the question whether it's material or not, but err on the side of caution and rather put it in, isn't it? Then we see the profit before tax note has a reversal and an expense. Deferred tax. I wanted to show you the deferred tax. Okay. What you see with deferred tax is just a normal deferred tax calc. Yeah. A normal deferred tax calc where our asset carrying amount has been reduced by impairment, isn't it? Now, what usually happens or what arises because of this deferred tax, this isn't even the deferred tax calc here. Okay, so what you see at beginning of year, when we still had the impairment, is that because of the impairment, our carrying amount had dropped, isn't it? Usually what we find is that wear and tear is bigger than depreciation, isn't it? And we'll end up with a deferred tax liability. However, when we have impairment, we'll end up in the opposite position, where when we add impairment to depreciation, we've written our asset down more than SARS. So when you see this line, you'll see that in this case, when we had the impairment, the carrying amount is actually smaller than the tax base. When I say one minus the other, I'll end up with a minus, yeah, and I would put brackets around it. When I times a minus by minus 28%, I'll end up with an asset. So whereas usually with our PPE, we see a deferred tax liability. Do you agree? We see a deferred tax liability. When we have impairment of assets, usually then we'll end up seeing a deferred tax asset. Okay, but it's nothing to panic about. Just always remember that if you don't land up with an asset, just to double check your calc. And the reason for that is because our carrying amount has been reduced by the impairment, and so therefore we'll end up with the amount being smaller than the tax base. What you see happens in the next year, when I reverse the impairment, I go back to what I usually see in the deferred tax, which is carrying amount bigger than tax base, leaving me with a temporary difference, which results then in a deferred tax liability. Yeah, and it goes the other way. So impairment doesn't have any specific special tax implication as such. SARS does not give you a deduction for impairment, isn't it? Because it's just accelerated depreciation. In your tax calc, you would reverse impairments if there was an impairment. SARS doesn't give you an allowance. SARS gives you wear and tear, wear and tear, wear and tear. If you sell the assets or write it off, SARS gives you scrapping, isn't it? So if this asset was damaged and I wrote it off, SARS would give me an allowance called a scrapping allowance. Yeah. So SARS doesn't care about what you do for accounting. Okay. Assignment 2. Assignment 2 is multiple choice. Yay. But this one, we've done the big one. Sometimes you see these assignment 2s, you think, oh no, here comes a big one. Assignment 2 is multiple choice. It's 10 questions, I think, and it's 2 marks each. It is predominantly about intangibles. And we're only going to do intangibles next week. However, one of the intangibles, this one here at the bottom of the assignment, this one, is actually a question about impairment. And although it is an intangible, this lecture, all the assets we've been looking at have been intangibles. Did you notice that? And we're going to talk next week about intangibles, and especially about these internally generated intangibles, because that's a bit of work. But your normal purchased intangibles, we account for like we do PPE. We buy it, it has a life. Usually they don't have a residual, so they're easy to work out, isn't it? But what you can see from this is it is an impairment question. Yeah. On the 1st of January, SASOX acquired the right to use Falcon extract model to produce oil from coal at a cost of 2.5 million rand for a period of 5 years. 2.5 million. Legal fees of 95 were incurred on the acquisition of the rights. Do you agree? 95 of legal fees would be included in my cost. I will add it to my cost of acquisition. And so my cost of acquisition is actually 2,595. Remember that for tax, legal fees are not deductible. Yeah. So when I'm working out tax base, if they ask you for tax base at some stage, it won't include the 95. It will only be on the 2.5. Okay. The rights were available as intended by management from acquisition date and have a residual of 0. Usually intangibles have a residual of 0. The reason for that is there isn't an open market where you can buy and sell used intangibles like we can used cars, or isn't it properties. So usually 0. Due to a significant decrease in the oil price as a result of oversupply of oil, global oversupply of oil, the value of those rights has declined, and management determined that fair value less costs to sell was 1.3 million. And this is now 2015. When did we buy it? Oh, okay. I think it's 2 years later. But we just need to check the year end. Is it December, the year end? Yeah, December 15. Yeah. Okay, so December 15, there's the date. So we're going January 14 to December 15, so 2 years. Yeah, December 14, December 15. Management estimated that the rights will generate the following net cash flows, so that's important, net cash flows over its remaining useful life. There were 5 years, there are 3 years left. This one works, that one that we saw didn't work, okay, with the 8 years and the 5 years left. But this one seems to work. At January 14, there were 5 years. 2 years later, there would be 3. So these are the 3 years. There's your net cash flows for the 3 years, and you have to work out a value in use. Okay, next page. It's the company policy to account for intangibles using the cost model and to amortize straight line. A pre-tax discount rate of 16% is considered appropriate. We will use that to do the cash, to discount the cash flows. SARS allows a 5% tax allowance on internally generated and purchased intangibles. So this is SARS, 5% tax allowance for SARS. In terms of section 11 GC, straight line, not apportioned. But we don't have a problem with apportioning, because we bought it 1 January and our year end is December, so there's no problem anyway with apportioning. Deferred tax is provided for all temporary differences. There are no other items causing temporary or exempt differences except those in this question. There will be sufficient taxable profit in future against which any unused losses can be utilized. And the reason they tell you that is because we could land up with an asset. Hey, when we land up with a deferred tax asset, we always have to check this because it might limit the amount of asset that you're able to keep. Okay, so that's that. You can come in, just give me 2 seconds. Question 1 we can do. Question 1 is a little theory question on impairment. What is value in use, I think, is a question there. Then question 2 is again IAS 36 impairment. That one we can do. This one, question 3, is about intangibles. We'll do that one next week. Question 4 is related to the formula that we generated. So question 4 we also can't do. We'll do next week. It's got to do with this development of this formula. So that's not the one we're looking at today. Question 5 is also intangibles with a research and development formula. That one we can't do. Question 6, the remaining useful life of the formula, we also can't do. Come on, give us a break. Question 7, the amortization expense relating to the purchased rights. Okay, that one we can do. Amortization expense relating to the purchased rights. The recoverable amount for the purchased rights. That one we can do. 8. The remaining useful life of the purchased rights. In our intangibles, that's the one thing that's different in intangibles to PPE. We disclose remaining lives. I don't know, in a little like paragraph, no, in a little sentence at the bottom. Question 10, the tax base of purchased rights. Okay, so there's a few we can do. Is it about 5 or 6? All right, so no reversal of impairment, it looks like. There isn't always a reversal. You need to go back here. You need to do the calculations of carrying amount, fair value less costs to sell, and value in use at 16%. And then you have to do the tax as well. We can take a little break. I see we have a visitor. All right, we have a look. Question 1, Zazie, I'm going to ask you first. What do you think the answer is? A only? No. A, B, D, and E. What did you say? So you say it's... Sorry? I'm confused now. Okay, let's go back. Zazie, what's the answer for number 1? Number 4. What did you say? Christian? 4 as well. 4? 4, yeah. If you look at the notes, you'll see in my notes, under value in use, that almost all of those are there. Which one did you leave out? Yeah, it is there. It's there in the notes that I gave you. Time value of money. All right, so question 1 is 4. It's just pure theory. All of these are in that handout. Question 2, according to impairment, what would we include in the future cash flows? Ashley? You don't know. Christian? What did you guess? 3. Also 3. Phil? 1. 3 as well. You didn't have a chance to see. 3. What did I say? I said 2. Okay, let me see what you guys said for 3. A, B, C, and D. Okay, so we know that tax definitely not, isn't it? So we've always been excluding tax, and if you look at the notes, it actually says they exclude financing and tax. So wherever we had an E, it's not those. So it's not those 2. Okay, so then A is definitely in, it's in all of them. A is the projections of cash outflow that are necessary, and B is the cash inflow. And we saw in some of the questions we take the cash in less the cash out, isn't it? And so we know that those 2 are definitely in, so then it's not 1, so it's between 2 and 3. So that only leaves us with then to look at whether C and D are correct. And one of those is definitely incorrect. You see that it says here, cash outflow from enhancing the performance of the asset. We're looking at how the asset is now. Not if I then spend money and put in a new motor, what will the impairment be? Hey, you'll sometimes see that in questions. So we've had a truck and the engine blew up or whatever. What does the engine do? Seize or whatever. And so at your end, the truck's impaired. I have to impair it. Next year, if I replace the engine and the impairment reverses, I'll then reverse it. But at your end, whatever the condition is, I test impairment as the asset is. And if you look in your handout, you'll see that it said there, in the current condition of the asset. Definitely said that in the notes. So then we definitely would not look at cash flows from enhancing the performance of the asset. That's not how the asset is now, isn't it? That's how the asset will be if I fix it. So that one is definitely not true. Cash outflows that relate to obligations that have already been recognized as liabilities. Remember I said to you we're looking at future cash flows. If it's a cash flow that's already a liability, it's already expensed, isn't it? Is it a future cash flow? No, it's already expensed. It can't be a future cash flow. So that one is also not, because it can't be future cash flows. It has to be future cash flows, and that one is not. If it's already in liabilities, it's already expensed, it's not a future cash flow. So for me, the answer is 2, not 3. All right, then question 3 we couldn't do, or 4, or 5, or 6, so we were on 7. The amortization expense for the purchased rights is, Nikita, what did you have? 3 for the year ended December 15. What did you say? 2. How did you work out 3? So you're confused with 8. It's 2595 divided by 5, isn't it? 1 year of amortization is that one, 519. The recoverable amount. What's the recoverable amount? This was something you worked out, right? What did you say it is? 1328519. 1328519. Yeah. This is value in use if you put those numbers into your cash flow function on your calculator at 16%. And it is bigger than the fair value, which was only 1.3 million, isn't it? And recoverable amount is the higher of the two. Okay, so the number crunching you guys can do. The remaining life on the right is how many years, Jolinda? 3 years. This was such a funny one, wasn't it? Why do they ask such a funny question? 9 years, 9 months. I don't know where they get the months from, because it's not months. It's not indefinite, although it is possible to have assets with indefinite lives, like goodwill, for example. But yeah, 3. Oh yeah, it does these funny things where it just goes berserk. All right, and then the last question, question 10, is the tax base. Oh, I didn't like this one. What did you get for tax base? The first one. Yeah, I don't know. Remember I said to you legal fees are not deductible, right? So legal fees are not deductible. SARS would never include them in the cost of an asset. So for me, the tax base would have therefore been the 2.5, and there are 20 years of life for SARS because it's at 5%. There's 18 years remaining, or you take 5% off, whichever way you want to do it, isn't it? And you get a number which is 2250. However, that answer wasn't there, so then if you take 2595, if you leave the legal fees in, and you times by 18 over 20, in other words, you take 10% off, whichever one you want to do, because when you take 10% off, that's 5% for 2014 and 5% for 2015, it gives you 2335.5, and then it is answer 1. It's not null. I don't know where they're getting those other answers from, unless the percentages are wrong, but they said 5%, isn't it? So it's over 20 years. So, yeah, that's that one. So we've done, I think, is it 5 we've done? 1, 2, we've done 6. So the other 4 are to do with the formula. We'll do them next week.